Oil just hit $100 per barrel. The S&P 500 is down. The NASDAQ is down. Gold, the asset that has functioned as humanity's crisis hedge for 5,000 years, is down 3% since this war began. And Bitcoin is up 7%. That is not a typo. That is not cherry-picked data from a favorable window. That is the verified price performance of every major asset class from February 28, 2026, the day the United States and Israel struck Iran, through March 12th, the day this video was published. Oil at $100 is supposed to crash risk assets. It is supposed to trigger inflation fears, kill Federal Reserve rate cut expectations, compress corporate margins, and send investors sprinting toward the dollar and gold. That is what every financial textbook says happens when a military conflict sends crude to triple digits. The textbook is not wrong about stocks. The S&P 500 is behaving exactly as expected. The textbook is completely wrong about Bitcoin. And understanding exactly why Bitcoin is doing the opposite of what conventional financial wisdom predicted is the most analytically important question in crypto markets right now. This video is going to answer that question with the precision it deserves, using verified data from CoinDesk, Fortune, Elliptic, Bloomberg, Nansen, CF Benchmarks, and Wintermute. Not with hype, not with price predictions. With the specific evidence that exists right now on March 12th, 2026, and what it actually tells us about what Bitcoin is becoming as a financial asset. Before we go any further, the essential disclaimer. Nothing in this video is financial advice. Bitcoin is an extremely volatile asset. It fell from $126,000, its all-time high reached on October 6th, 2025, to approximately $62,500 before this conflict began. That is a drawdown of nearly 50% from peak to trough. Nothing in this analysis changes that reality. Consult a qualified financial advisor before making any decisions about your portfolio. This video exists to examine a specific data pattern in a specific market environment. What you do with that examination is your responsibility. To understand why Bitcoin is behaving the opposite of what oil at $100 should theoretically produce, you need to understand what actually happened in the first hours after the strikes hit Tehran. Because the first hours tell you what Bitcoin still is, and the subsequent 2 weeks tell you what Bitcoin is becoming. At 9:45 in the morning, Tehran time on February 28th, coordinated United States and Israeli airstrikes struck nuclear facilities, missile sites, and the district of the capital where Supreme Leader Ayatollah Ali Khamenei resided. Iran confirmed Khamenei's death hours later. Oil markets went vertical. Brent crude touched $100 per barrel. The conflict that analysts had modeled for years as a tail risk became the actual present. Crypto markets reacted instantly. Bitcoin dropped from approximately $67,000 to below $64,000, shedding nearly 5% in minutes. The total crypto market capitalization shed $128 billion. Over $300 million in leveraged long positions were liquidated in the first 24 hours. The crypto fear and greed index collapsed into extreme fear territory, where it has remained throughout the conflict. That initial reaction is the reaction of a risk asset. Bitcoin fell. Oil surged, gold surged, the dollar strengthened, treasuries attracted safe haven flows. Every conventional financial dynamic played out exactly as the textbooks predicted for about 24 hours. Then something unexpected happened. Bitcoin recovered, not slowly, not tentatively. Within 24 hours, it had climbed back above $67,000. By March 10th, it was touching $71,000. By March 12th, it was trading at approximately $70,400, up 7% from pre-conflict levels. While oil remained near $100, stocks remained under pressure and gold was down 3% for the same period. CoinDesk reported on March 12th that Bitcoin is climbing the wall of worry amid escalating war and stock market losses. Fortune reported on March 11th that Bitcoin is outperforming gold in stocks since the beginning of the Iran war, calling it a welcome sight for the digital assets sector. The comparison is unambiguous. Bitcoin up 7%, S&P 500 down 1%, gold down 3%, silver down 9%. Bitcoin is the only major asset class in positive territory since this war began. There are 4 specific mechanisms that explain this. Each one tells you something different about what is actually happening. The first mechanism is the one nobody in mainstream financial media is talking about, and it is the most architecturally fundamental of the 4. Oil at $100 happened on a Saturday. American equity markets were closed. Bond markets were closed. The CME was operating on reduced hours. Traditional financial institutions were running weekend skeleton staff. The institutional machinery of global finance, the mechanism through which capital normally responds to price shocks, was largely offline. Bitcoin was not offline. Bitcoin is never offline. Gabe Selby, head of research at CF Benchmarks, stated in Fortune's reporting on March 11th that crypto's 24/7 structure is increasingly an edge for the asset class. That observation understates what actually happened on the weekend of February 28th. Bitcoin processed the entire initial panic in real time, while every other major asset class was frozen. Equity markets could not price the oil shock until Monday morning. Bond markets could not price it. The currency markets could, and did. The dollar strengthened sharply over the weekend. But for investors who wanted to reposition risk assets in response to oil at $100 on a Saturday morning, Bitcoin was the only market open for business. The result was that Bitcoin processed its panic. The initial drop to 63,000, the forced liquidations, the extreme fear readings, over the weekend, while equity markets had not yet opened. By the time American stocks opened on Monday, Bitcoin had already found its floor and begun recovering. The acute phase of the panic had already cleared through the crypto market's price discovery mechanism, while equity markets were still closed. Euronews captured this dynamic precisely on March 5th, noting that for the first time in many observers' memories, crypto markets were effectively functioning as the primary financial market during the initial hours of a major geopolitical shock. Matt Hogan of Bitwise called the weekend of February 28th, the weekend that changed finance. That framing may be dramatic, but the underlying observation is analytically correct. The 24/7 structure of crypto meant that it absorbed and processed the initial oil shock, while traditional markets were structurally unable to respond. That is not a temporary or coincidental advantage. It is a permanent architectural characteristic of Bitcoin that becomes more valuable, not less, in a world where geopolitical crises arrive on weekends, at night, and in time zones where traditional markets are asleep. The second mechanism is the one with the most concrete on-chain evidence, and it is the most important for understanding Bitcoin's long-term trajectory. Within minutes, but not hours, minutes, of the first airstrikes hitting Tehran, crypto outflows from Nobitex surged 700%. Nobitex is Iran's largest cryptocurrency exchange. It serves 11 million users and processed $7.2 billion in transactions in the year before this conflict. According to Elliptic's co-founder and chief scientist, Dr. Tom Robinson, the surge in outflows potentially represents capital flight from Iran that bypasses the traditional banking system. 700% within minutes. Chainalysis documented the same pattern, recording an even larger spike in their own measurement methodology. Nearly $3 million in withdrawals were processed from Nobitex in the first 24 hours of the conflict. Each subsequent announcement of fresh United States sanctions on Iranian entities produced a new spike in crypto outflows. Each time the traditional banking system closed another door, Iranians used Bitcoin to find a different door. This is not metaphorical. This is measurable on-chain behavior by 11 million real people responding to a real emergency. Iranians did not do this because they read a white paper about decentralization. They did it because their banks were closed, their currency was collapsing under the weight of military conflict, and Bitcoin was the only financial system still open and still processing transactions. This is the specific dynamic that oil at $100 cannot produce in Bitcoin the way it produces panic in equity markets. Oil at $100 threatens corporate margins, consumer spending, and Federal Reserve policy. It does not threaten Bitcoin's ability to process transactions. Bitcoin does not have a supply chain that runs through the Strait of Hormuz. It does not require Iranian compliance, Chinese cooperation, or Saudi Arabia's continued willingness to price crude in dollars. It requires electricity and mathematics. Both remain available regardless of what happens to the price of a barrel of oil. The third mechanism explains why Bitcoin's price recovered as fast as it did after the initial drop. The crypto fear and greed index has been in extreme fear territory since this conflict began. Bitcoin funding rates, the cost of holding leveraged long positions, have been negative throughout the conflict period, meaning the derivatives market is structurally skewed toward bearish bets. Retail sentiment, by every available measure, is in maximum fear, and yet Bitcoin is up 7%. The disconnect between maximum fear sentiment and positive price performance has a specific explanation. Institutional capital was buying the drop. CoinDesk reported on March 12th that Bitcoin's outperformance during this period likely stems from big traders and institutions accumulating in privately negotiated transactions, keeping demand steady during a period when retail investors were in panic mode. BlackRock's iShares Bitcoin Trust attracted nearly $1 billion in fresh inflows during the first 11 days of March. This is the same fund that lost more than $3 billion in net outflows between November 2025 and February 2026, the worst sustained ETF outflow period since spot Bitcoin ETFs launched in January 2024. The reversal of that trend, occurring specifically during a period of maximum geopolitical stress and extreme fear sentiment, is not a coincidence. It is institutional capital identifying a favorable entry point during a period when retail sentiment is suppressed, and the asset is demonstrating the precise value proposition that justifies institutional allocation. Aurélie Barther, principal research analyst at Nansen, identified the specific behavioral signal that institutional desks were watching. She noted that one encouraging sign during this conflict is how little Bitcoin has reacted to fresh geopolitical headlines. Each new military development, each new sanctions announcement, each new oil price update producing smaller and smaller price reactions in Bitcoin compared to equities. That muted reaction to escalating headlines in a market environment where every new development is producing volatility in every other asset class is precisely the behavioral pattern that distinguishes a maturing store of value from a pure speculative instrument. Institutional capital recognizes that pattern. The flow data from BlackRock confirms they are responding to it. The fourth mechanism is the most structural and the most consequential for understanding why oil at $100 and Bitcoin going up are not actually contradictory. They are causally connected. Jake Ostrovsky's, head of OTC trading at Wintermute, made an observation during this conflict that cuts directly to this connection. He noted that the oil price move matters more for crypto than the geopolitics itself. This sounds counterintuitive until you understand the specific transmission mechanism he is describing. Oil at $100 kills Federal Reserve rate cut expectations. High oil prices mean sustained inflation. Sustained inflation means the Fed cannot cut rates without abandoning its mandate. Elevated rates mean higher real interest rates across the economy. Higher real interest rates are a structural headwind for all risk assets. And they are also, simultaneously, the environment in which fixed supply assets like Bitcoin become structurally more attractive relative to dollar-denominated instruments that lose purchasing power as inflation erodes them. The analysts from the London Crypto Club, David Brickell and Chris Mills, extended this logic to its structural conclusion. They argued that regardless of whether this war is short or long, Bitcoin's position is asymmetrically favorable because the United States government will ultimately need to expand the monetary base to fund the military spending this conflict requires. War spending, like pandemic spending, eventually requires monetary expansion. Monetary expansion in a system with a fixed supply alternative eventually flows toward that alternative. The same dynamic that drove Bitcoin from $3,000 in 2018 to $68,000 in 2021, pandemic-era quantitative easing expanding global liquidity by trillions of dollars, will operate again in a war spending environment. This is why oil at $100 and Bitcoin going up are not actually in contradiction. Oil at $100 accelerates the fiscal and monetary pressures on the dollar-denominated financial system that make Bitcoin's fixed supply increasingly relevant. The Strait of Hormuz mines are not just a military problem. They are a stress test on the specific guarantee, American military supremacy over international shipping lanes, that underpins the entire petrodollar arrangement. Bitcoin does not require that guarantee to function. That distinction is becoming financially visible in real time. Now, the part that actually earns your trust. Everything described in this video is real data from verified sources. Bitcoin is up 7% since February 28th. The Iranian capital flight data is documented by Elliptic and Chainalysis. The institutional inflow reversal at BlackRock is on record. But there's a set of facts that is equally real, and that this analysis requires you to hold simultaneously. Bitcoin dropped 5% in the first minutes after the airstrikes hit Tehran. It liquidated $300 million in long positions within 24 hours. The initial reaction was precisely the reaction of a risk asset, not a safe haven. Gold in the first moments of the conflict outperformed Bitcoin. The traditional safe haven bid went to gold and the dollar before it went anywhere else. Bitcoin ETFs lost $4.5 billion in net outflows in the 2 months before this conflict began. Over the same period, gold ETFs absorbed $16 billion in fresh inflows. The rotation from digital gold to actual gold is one of the most visible macro trades of early 2026. That rotation tells you something real about where institutional conviction currently sits. The MEXC analysis published during this conflict stated the market reality directly. Bitcoin is down approximately 47% from its all-time high of $126,000 reached in October 2025. If the conflict adds to existing macro headwinds, tariff pressures, sticky inflation, slowing growth, the downside could extend toward $50,000 to $55,000 before any recovery. That is real downside risk. Anyone telling you Bitcoin only goes up in a war environment is not looking at the full data set. The honest analytical conclusion is this: Bitcoin is demonstrating, for the first time in an active military conflict with oil at $100 and equity markets under sustained pressure, that it can recover faster than traditional assets from an acute geopolitical shock and outperform those assets over the subsequent 2-week period. That is not the same as being a safe haven. It is the early, measurable, on-chain evidence of a behavioral transition from pure risk asset towards something more structurally complex. That is visible in this data, but is not yet complete and is not yet reliable enough to depend on in a crisis. Pay attention to what the data shows, not what it feels like it should show. The gap between those two things is exactly where the most consequential financial insights live, and exactly where most investors are not looking. You just spent 30 plus minutes working through one of the most data-intensive analyses of Bitcoin's behavior during an active oil crisis that exists anywhere on this platform right now. You did not just hear that Bitcoin is going to the moon because oil is going up. You did not just hear that Bitcoin crashed because it is a risk asset. You heard both things because both things are true. And you sat with that complexity until you understood what it actually means. That precision is rare. And it is the only thing that separates investors who understand what is happening from investors who react to what already happened. Wherever you're watching this, drop a comment below with your location and one word that describes what Bitcoin's performance during this conflict proves to you. I read every comment. While you're down there, hit like and subscribe if you have not already. It takes 2 seconds, and it directly helps this channel reach the investors who need this analysis before the next crisis arrives, not after it. The single most important thing you can do right now is share this video with one person in your life who is trying to understand what oil at $100 actually means for their portfolio. Not because sharing helps the channel, though it does, but because the gap between mainstream financial coverage of this conflict and what the on-chain data actually shows is real, consequential, and closing fast for anyone who waits too long to understand it. Thank you for your focus. Thank you for your intellectual honesty, and I will see you in the next one.